Ladies and gentlemen, good day and welcome to Q2 FY23 earnings conference call of Barbeque Nation Hospitality Limited, hosted by Ambit Capital. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amandeep Grover from Ambit Capital. Thank you, and over to you.
Thank you. Good evening, everyone. Welcome to Q2 FY23 earnings call of Barbeque Nation Hospitality Limited. From the management, we have with us Mr. Kayum Dhanani, Managing Director, Mr. Rahul Agrawal, CEO and Whole-Time Director, Mr. Anurag Mittal, Chief Financial Officer, and Mr. Bijay Sharma, Head of Investor Relations. Before we begin the presentation, I would like to remind you that some of the statements made in today's conference call may be forward-looking in nature and may involve risk and uncertainties. Kindly refer to the earnings presentation for detailed disclaimer. I now hand over the conference over to Mr. Kayum Dhanani. Thank you, and over to you, sir.
Thank you. A very good evening, ladies and gentlemen. I take the pleasure in welcoming you to Q2 FY23 conference call of Barbeque Nation. This was a milestone quarter in terms of store additions as we crossed 200 marks during the quarter. We celebrated this milestone event by participating in Dhan Utsav festival, serving meals to 200 underprivileged kids across each of our 200 restaurants, serving 40,000 meals. We added 10 new stores during the quarter, taking our total store count to 205 stores, and remain confident of achieving our guidance of 40 stores for FY23. On the existing 205 restaurants, Barbeque Nation India Network has 186 restaurants, Toscano has 13 restaurants, and international portfolio includes 6 restaurants. We continue our growth momentum in Q2 FY23 with year-on-year revenue growth of 41%. This was driven by 23.4% same-store sales growth and new store additions. Our dine-in business has grown by 61% on year-on-year basis, again driven by volume increase and increase in average realization. Our dining business growth was partially offset by 23% year-on-year decline in delivery revenues. While our delivery business volumes have increased on year-on-year basis, average order values have come down due to the change in product mix. Our delivery business has stabilized during the quarter, and we are starting to see marginal uptick in monthly delivery revenues. As discussed during the last quarter, with the objective of further enhancing our delivery portfolio, we launched a biryani brand called Dum Safar. Dum Safar was launched during the second half of the quarter across 25 locations. The initial response to this product has been very encouraging, and we plan to launch Dum Safar across all our restaurants in a phased manner by the end of FY23. Our gross margins improved by over 40 basis points during the quarter as compared to the previous year, and dropped by 70 basis points as compared to the previous quarter. This was primarily led by input cost inflations. We are seeing moderation in some of our input costs and believe that the gross margins should marginally expand during the second half of the year. Our reported EBITDA margin was 19.3% as compared to reported EBITDA margins of 22.6% in same quarter of the previous year. However, last year we had the benefit of some one-off rent waivers, adjustments for these waivers. Our core EBITDA margins remained flat compared to the same period last year. This translates to a core EBITDA growth of 39.1% versus the previous year. Our margins are also impacted by the higher mix of new and yet to mature restaurants. Our restaurant level EBITDA margins for the matured restaurant continues to be strong and healthy. We continue to remain focused on our core strategy of expanding the Barbeque Nation India network, building a strong delivery business, growing the Toscano brand, and calibrated expansion of our international business. We are extremely focused on growing each of these four verticals to build one of the largest food service companies owning its own restaurant brands. With this, now I hand over to Rahul to take you through the quarterly performance. Thank you very much.
Thank you, Kayum. Good evening. In quarter 2 FY23, consolidated revenue from operations were 310.5 crores, delivering a year-on-year growth of 40.6%. This was driven by same-store sales growth of 23.4% and network expansion of 40 new stores during last 12 months. On sequential basis, overall revenues were relatively flat, despite the fact that Q2 is a seasonally weak quarter for the business. Dine-in business grew by 61% over last year, driven by both volume growth and increase in average price realization. In the delivery segment, delivery transactions have increased on year-on-year basis. However, average order value has declined due to the change in product mix. This led to overall delivery revenue declining by 23% versus the previous year and around 65% versus the previous quarter. The share of our box business has declined and share of a la carte orders have increased. Based on our menu re-engineering exercise, we also launched few combo meals which got very encouraging response. Launch of Dum Safar also added to the delivery revenue, though marginally. Dum Safar was operating in 12% of our network, and that too broadly for only a month. After a few quarters of sequential decline in delivery, we are seeing uptick in our overall daily delivery sales and believe that going forward, delivery business should start contributing to overall growth. On segment basis, each of the three businesses have performed well. Barbeque India revenue grew year-on-year by 38%. Revenue from Toscano business doubled compared to same period last year, and our international business recorded a year-on-year revenue growth of 28%. Consolidated gross margin for the quarter was 66.1% compared to 65.6% in quarter 2 FY22. We were able to marginally improve the gross margin as compared to the last year, despite inflationary pressure on input cost. Our calibrated price hikes in the past year and improved operating efficiencies enabled us to manage gross margins better. On sequential basis, gross margins declined by 70 basis, largely led by input cost inflation. We have also not taken any structural price hikes during the quarter. We are already seeing some softening in core input cost and believe that gross margins should marginally improve in H2 of this fiscal year. Reported EBITDA for the quarter was around 60 crores with margins of 19.3% as compared to EBITDA margin of 22.6% in the previous year same quarter. EBITDA for comparable quarter last year included some one-off rental waivers, as they mentioned. Adjusting for these, the margins were flat, and our core EBITDA also grew around 39% year-on-year. Adjusted EBITDA margin, which is pre-Ind AS numbers, Ind AS 116, was 10.5% during the quarter and grew by 28.2% versus last year. Again, adjusting for these one-off waivers, rental waivers that we got last year, the growth in EBITDA, core adjusted EBITDA without Ind AS 116 was around 75%. EBITDA margins also has the impact of new store added during last 1 year and which are yet to mature. Out of total network of 205 restaurants, 47 restaurants are classified in the new restaurants, and out of this, 40 were added only in last 1 year. The core portfolio of matured store continues to do well. Despite quarter 2 being a seasonally soft quarter, this matured portfolio delivered average annualized revenue of 6.67 crores per restaurant with average operating margins of 19.2%. This is restaurant operating margins, again pre-Ind AS 116. On H1 basis, this matured portfolio delivered annualized revenue of around 6.8 crores per restaurant with restaurant operating margins of around 20%. As we enter sequentially a seasonally stronger second half of the business, we remain confident of delivering the average annualized revenue of 7 crore per restaurant with around 21% restaurant operating margin in our matured portfolio. We also reported net cash flow from operating activities of rupees 135 crore during first half of this fiscal year, and net of lease payments, the net cash flow from operating activities were 73 crore for H1. Overall app downloads have also increased to around 5.1 million, and the share of Barbeque Nation India revenue from own digital assets have grown to around 28.7% in quarter 2 FY23. We also added 10 new restaurants during the quarter, taking the overall network to 205. Out of these 10 restaurants, 7 were added in metro and tier 1 markets and 3 were added in tier 2 cities. Metro tier 1 and tier 2 tier 3 cities mix remain at around 70-30 mix. Further, we have around 16 restaurants under construction and an equally strong pipeline of sites under evaluation. As Kayum mentioned, we are confident of adding 40 restaurants during the year, and broadly this will include 33-35 Barbeque Nation restaurants in India, around 4-5 Toscano restaurants, and 1-2 Barbeque Nations in international business, again primarily Middle East. Also, to reiterate, each of our business segments are independently generating operating cash flows, and these operating cash flows are primarily used for expansion in respective segments or geographies. We do not need to allocate any capital from our Barbeque Nation standalone balance sheet to our Toscano business or international business for the planned expansion in these businesses. We remain focused on our four-pillar strategy of accelerating Barbeque Nation India dining business, growth in delivery, unlocking the growth potential of Toscano, and again calibrated international expansion to drive growth going forward. We can now open the session for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Percy Panthaki from IIFL. Please go ahead.
Hi Rahul, good morning. My first question is on CAPEX. Would you be able to give some idea on what is the total CAPEX you would do at a consolidated level for FY23 and FY24?
So for the 40 restaurants that we are opening up and including the CAPEX for maintenance and some CAPEX will also go towards our biryani project, we'll do approximately 135 crores of CAPEX in this financial year. And based on the growth plan for next year and assuming that it remains at between say 40 to 45 restaurants, next year also the CAPEX would be anywhere between 135 to 150 crores.
Okay, understood. Secondly, on your delivery sales, which is down about 20% YOY, any thoughts on that? Why this is happening? I mean, on such a small base that too?
So like I mentioned in our opening remark, our share of business mix is changing. Our share from the box business is coming down. Currently, it's approximately 45% and our a la carte order business has gone up, and that obviously is a individual consumption order, and the AOVs are lower there. So what I'm actually most excited about is the fact that between last year and this year, our transaction volumes have gone up. There's no doubt that we were grappling with the fact that our delivery business was going down sequentially over last 5-6 quarters, right? So the priority of the management team was to ensure that you come up with a product which sort of fits the consumer need. Given that the barbecue in a box business was coming down, it was more of a group eating sort of product, right? Now, as I said, in the current exit month of say September and also continuing that in the month of October and November, we are seeing that the numbers on a monthly basis are actually at 5-month high. So we have broken that sequential decline trend now, and given that we also launched new combo offers and the transaction volumes are up, I expect this business to now start contributing to the growth. So Q3, for example, is already looking up from what we were in the previous quarters. And so this is the short term. Long term, I think we will be at an average AOV of anywhere between 500 to 550, and then focus on growing the transaction volumes in this business.
So how long you think before we go back to our original 50 to 55 crore per quarter run rate on delivery?
So look, based on the current numbers, maybe Q1 of next year, or if I look at cumulatively, so what you're saying is 200 to 250 crores number. FY24 should be really achievable. There's Q3 itself is looking up from where we were at in Q2.
But that could also be a normal seasonality, Q3 always being better than Q2, right?
So you're right, but like I said, our September numbers were also good, right? And September numbers also were seasonally, weak, given that there are a lot of vegetarian consumption days, right?
Right.
And that trend also continued in the month of October, which also had, festivals like Diwali, and those festivals. So I think based on what I'm seeing both in the month of September and October, I'm excited about the uptick that we are noticing in this business. And obviously Q3 should help, like you said, with better performance in the month of December. So, to answer your question, 55 crores, which is annualized 200 crores, FY24 given that there will also be some new sites which will add up to us, should be really achievable.
Understood. And on your guidance of 7 crore per restaurant and 15% margin on an annual basis, that's for the mature store, right?
Yes.
But how would this look at the overall company level, including the new stores? These numbers would need to be adjusted to what extent?
So for this financial year, look, the new store portfolio is actually not even 2-year-old, but only 1-year-old, right? And if you look at the recent opening in last 2 quarters, we had opened practically half of this, and that too in a seasonally weaker first half of the business, right? So overall, the impact on margin decline because of this new portfolio maybe 1% at max. But good thing is that even this new portfolio is actually more skewed towards metro markets. And in metro markets, which are also one premium site as compared to say tier 2, tier 3, and the rental on a per square feet basis that you pay in these markets are more. So the initial losses in these businesses are actually higher because it takes in our business at least 3 to 6 months to even stabilize, right? But since these are based in metro markets, the
FY23 obviously, because everything is so new, I understand the issue, and I'm not looking at FY23 at all, but more at a FY24 level. At an overall company consolidated level, this 15% for mature stores would translate into what? 13.5 for the overall company or 14?
No, so the drag should not be more than 1 percentage point. So
okay.
Maybe 14.25.
Okay. And last question on Dum Safar. Can you give some idea on how many cities it is in, or how many restaurants are servicing that, and also how do we see this ramping up over the next 1 to 2 years?
So as of September, we were in around 25 outlets. As of October, we are already in around 42 outlets. By end of December, we'll try and go to around 75, and hopefully try to be in all the outlets by end of this financial year. Month on month, we are seeing increase in average daily sales, in the outlets that we launched. I think it's too early. The exciting thing is, the response, the ratings that we have on this business. Obviously, there are product trial, there are some initial changes that we need to do to the menu also, but the initial response on this has been very good. Now, in terms of longer term picture, if I look at my UBQ business and see how that performed pre-COVID versus post-COVID, we used to do an ADS of around 3,000-4,000 rupees pre-COVID. That ADS in UBQ business has gone to around 20,000 rupees. Now, even if we do say 5,000 or 10,000 rupees ADS in our Dum Safar brand, and we all know that biryani is one of the large categories, 5,000 ADS at 200 sort of outlet base will give us approximately 1 crore every month, which is around 1% adding to the top line, right? So, like we said, we own the infrastructure, we own the capability to serve multiple different SKUs, and then can we create more brands out of these, and then add to the overall revenue potential of these outlets. So that's the broad numbers that we have right now. Again, we'll come back to you once we had some history of at least 3-4 quarters, right? Otherwise, it's too early to sort of comment.
Right. Thanks, and all the best. That's all from me.
Thank you, Percy. Thank you.
Thank you. We have our next question from the line of Pritesh Chheda from Lucky Investment Managers Private Limited. Please go ahead.
Sir, with this, the new stores being added in the system now on the regular basis, so we have 40 this year, and then we have this whole ramp up from 180 to 300 stores over the next 3 years. Will it continue to impact the margin and not bring in the overall operating leverage in the system and impact the matured store overall performance as well? Past calls, we had always discussed this, and you mentioned new store will not impact, but what we are seeing in the numbers is new store impacting. So your comments there would be very helpful.
So, look, it will impact. It has obviously impacted our numbers in this quarter, and in the past calls also, we had always said that we are looking at around 1 crore average revenue from a mature portfolio with around 21% margin. There will be some drag from the new store because it typically takes between 2 to 3 years for stores to mature, right? So that is there, but obviously in this quarter, it is, if you look at this quarter numbers, almost 25% of our portfolio is less than 1 year old. That too is been looked at for the seasonally weaker quarter, and that too where the portfolio is more skewed towards metro markets, where the initial losses are slightly more than what you will expect in a tier 2, tier 3 sites, right? I believe since the portfolio also is skewed towards metro markets, the revenue per outlet potential in these metro markets is higher as compared to tier 2, tier 3 markets, and that's why once this portfolio of 40 restaurants sort of goes through the initial cycle of 2 years, this will start delivering the same return as the mature portfolio.
Usually, what is the ramp up of a new store? If you could give from 0 to 6 months and 6 to 12 months in terms of revenue and in terms of operating profitabilities?
So 0 to 6 months typically flattish or very low single digit margins. For the entire first year, we would look at around 7 to 8% margins. Second year, we'd look at store margins of around 14-15%, and third year it will come to around 21%.
So, sir, when we are going to add 20% to our outlet this year. We are going to add about another 15 to 18% of our total outlet next year. So is it fair to assume that some amount of drag on the overall company margin will exist, and if it exists, by what percentage should it exist?
So as this entire portfolio matures, and obviously there is some same store growth should also come from the mature portfolio. So the drag which is higher now should come down over a period of time.
You mentioned 0 to 6 months is zero profitability, 6 to 12 months is single digit.
Yeah, for the entire full year, we will do around 7 to 8% margin. So actually, second half,
on the new portfolio.
On the new portfolio, yeah.
So the trajectory 0 to 6 is 0, 6 to 12 months is a single digit, and it takes 24 months to reach the restaurant operating margin number, right?
No, so I said second year would be around 15%, and the third year would be around 21%.
Okay. Thank you, sir.
Thank you.
Thank you. We have our next question from the line of Varun Singh from IDBI Capital. Please go ahead.
Yeah, thank you. So my first question is on the delivery part of business. So as you mentioned that the mix has changed, and primarily revenue contribution from the box business has come down to 45%. If you can give more detail regarding your understanding about what is the primary reasoning for the box business contribution coming down, and where do you see this number to stabilize?
So look, it has been coming down. So very difficult to give you a forecast on where this will stabilize. But broadly, what we're seeing is our ABs have been pretty much holding up over last 2-3 quarters at around 500-550 levels, right? So even in our box business, there are some products at around 900 rupees, and there are some products at around 600 and 700 rupees. And during the current quarters, we also come up with new combo offers whose proportion has increased on an overall basis.
Okay. And I mean, do you think that this reduction in the movement in the shift in the revenue mix from box towards a la carte is primarily because of impact of inflationary thing and because customers downgrading? Any analysis over there?
So this is also a group eating product. As we have things opening up, this did really well during COVID times. As things opened up gradually, this as a portion came down, but overall a la carte orders have gone up, which is more skewed towards individual consumption. So that is there. I don't think it is customer downgrading from just box to a la carte. Also, as we have increased our menus from menu options on combo offers, maybe there is some shift from box business to a la carte in terms of one box business is equal to now 1.5 a la carte order, right? We don't have detailed insights on that because large part of our business also comes from aggregators.
Right. And Rahul sir, if we say that, if you can also help us understand what kind of trends that we are building around delivery business, other than the menu innovation that we could optically see.
Sorry, what do you mean by in terms of trends?
Sir, strength in delivery business.
Oh, strength. Okay, sorry. Look, obviously, menu engineering is one part. Delivery ratings are another. We have seen now consistent ratings over quite some time. Overall, it's around 3.9 on the entire portfolio of some 200 restaurants. 2 years back, it was around 3.2. The acceptance in the infrastructure in the outlets is now more smooth in terms of operations. We obviously did some of our own restaurants, creating space for that. Delivery packaging materials also are very bulky, right? So operationally doing it from the same restaurant in an efficient manner, all these have now become part of our daily operating protocol at Barbeque Nation.
Okay, sure. So that's it from my side. Thank you very much and wish you all the best.
Thank you. Thank you very much.
Thank you. We have our next question from the line of Harit Kapoor from Investec Capital Research. Please go ahead.
Yeah, hi, good evening. So just had a few questions. One was on, this Q2 seasonality. So, Rahul, the 19% restaurant operating margin for mature.
Sorry to interrupt. Can you speak louder, please? Can you use the handset?
Yeah, can you hear me now? Is this better?
Yes.
Yeah. So what I was saying was the Q2 seasonality. So 19% restaurant operating margin for the mature stores. Rahul, is this normal for Q2? Is that the way the restaurant operating margin happens in this quarter? I'm asking from the context that we really don't have a normalized Q2, since listing. So just wanted to get your sense.
Yes, it is pretty normalized. 19% margin. If you look at our revenue from per outlet from mature portfolio between quarter 1 and quarter 2 are down by approximately 5%, which translated to around the 2% decline in our restaurant operating margin on the mature portfolio. And if you look at numbers, we've also given numbers pre-COVID. So if you look at adjusted EBITDA between pre-COVID versus now, quarter 2 FY20 also were around 8.7% margin, which is around 10.5% currently. And similar trends were also seen in the last year's same quarter. So quarter 2 margins being stretched in our business is definitely there. Plus, the only shift that happens is that if your days like Navratri falls in somewhere between quarter 2 and quarter 3. This time it was in quarter 2. Last year it was in quarter 3. So to that extent, there's some impact will also come in. But by and large, quarter 2 always operate like this.
Got it. The second question was, on the revenue side. So, if you look at, you spoke about international, but on the international side, is there how has the profitability been there in terms of margins, etc.? How we've kind of trended there?
So in H1 basis, international business is at a corporate level. We delivered 18% pre-Ind AS margin.
Okay, great. And what's the level of price increase in India that we've seen now on a year-over-year basis? Given what's happened on the cost side, you did pass on price hike. So weighted average based on a dynamic model, what's that number been like?
So on the between last year's second quarter and this year's second quarter, our pricing would have gone up by around 7-8%.
Okay.
This quarter we have not taken any price hike. So we did around 4.5% price hike in quarter 1.
Got it. And given you're saying that the cost table is now lower a little bit compared to what it was probably early part of the year, you don't see any reason for incremental price increases, right now?
Yeah. So we are not planning to do any incremental price hike in the second half. On the pricing side, I think meat prices are softening a bit. There is some inflation that we are seeing in our dairy pricing, but dairy is not a large consumption basket for entire portfolio. Meat is larger. So net basis, I think we are seeing softening of input food cost, and that should help in the second half of the year. We are not contemplating any price hike in the second half.
Got it. Last question was on Dumsafar. So while it's early days, you mentioned that the kind of model that you would like would be at least a 1 crore kind of a revenue on an incremental revenue on a per store basis if you are able to hit a certain daily sales number. But if from a cost standpoint, below gross margin, what's the incremental cost that is required to run this operation in a store in terms of people? Because rent, assuming, is a portion to the dine-in business. So what would that cost look like?
So one, obviously in this delivery business, gross margins contribution margins are lower because we have three variable costs, which is food cost, packaging, and commission. And below that, on the fixed cost side, to run this delivery operation, which also runs UBQ, we don't need incrementally more than one specialized, trained employee who can run the machines that we have incorporated. And apart from that, there are some electricity costs to run it. But cumulatively, between both of them, it's not a larger number.
Understood. And last question was, given that you've launched this biryani format now, I know you're rolling it out through dine-in stores currently, but does that now imply that kitchen expansion will also happen in the near term going forward, or that's going to be the second leg, really something to look forward to FY24?
So that's not our focus right now. Like I said earlier, we know that our delivery business was down sequentially for around 5-6 quarters, right? So the focus first was to stabilize this part rather than adding more capability in terms of adding more infrastructure. So happy to note that this is now at least stabilizing, and we should see this in this quarter. I'm not jumping to add new capacity on extension kitchen. We are anyway obviously also doing delivery from the new restaurant expansion that we're doing. So I'll just ride on that for some time. We'll definitely wait for 2 to 3 quarters to see how this performs. And based on the unit economics of the extension kitchens that we have already in place, we will then think about expanding it. But as of now, for next 2 to 3 quarters, I'm not looking at putting capital to that.
Got it. Thank you. Wish you all the best.
Thank you, Harit.
Thank you. We have our next question from the line of Amandeep Grover from Ambit Capital. Please go ahead.
Yeah, thanks for the opportunity. So firstly on the recovery, so we understand that last quarter you had a gap to add 10% covers in dine-in versus pre-COVID as corporate was yet to recover. So while acknowledging that 2Q is seasonally weak, so any sense on how dine-in now stacks up versus pre-COVID on like-to-like basis and trend in the recent months?
So it continues in the same fashion, Amandeep. Also, like I said, the October month also had some festive days, right? And for our business, which is one primarily non-veg and also primarily group eating out, going out and dining, it is not very amenable, or the business don't get any kick during these festive days. For example, Diwali period for us is slightly meaner, right? And October month had that 1 week of the entire impact pretty much for the entire country, right? So early days, but based on what we're seeing currently, it's pretty much same trend in terms of covers. A real kicker comes in the month of December.
Fair enough. Thanks for this. And secondly, on the gross margin front, so last quarter you had mentioned about getting better pricing, especially for meat, which is a large portion of your overall input cost portfolio. And apart from this, the delivery business being a bit lower on gross margin as it involves packaging cost and aggregator commission. So since delivery business was again impacted this quarter or even on sequential basis, can you help us with the sense on what was the exact rationale behind the impact on gross margin on sequential basis?
So on the meat front, we have one commodity, which is fish, which we largely import. That pricing was higher in quarter 2 as compared to quarter 1. So that is a big one. Also, across our other businesses, also for example, our international business, gross margin was down by around 1.5%. In our Middle East business, largely most of the items are imported, and there were some price hikes. Input cost hike. Similarly, on Toscano business, we had some marginal increase on the cost. So the gross margin decline between say quarter 1 and quarter 2 we saw across all the 3 verticals, right? The impact was lowest for Barbeque India and pretty much highest for international. But even adjusting for for these, the overall margin for these related to smaller businesses, which is both Toscano and international, were very strong. So now, also just to complete the thought on the fish item, post that the new shipments that we got in the month of September are at low pricing. So that gives me some confidence of H2 that, and we also have some inventory build-up happening during the quarter, which gives me confidence that H2 margins should be better.
So this is helpful. And just, as a follow-up to this, as you are, say, with the addition of combo offers in the delivery business, as you mentioned earlier, with no pricing expected, do you see this would impact the margins, or it is not more of a discount but a different offering?
No. So combo offers actually are better in terms of food cost. As in the food cost is lower for the company in combo meals. The food cost is among the highest for the company in a box product. So it won't impact the margins.
Sure. And lastly, on the expansion front, so you've already added 20 stores for Barbeque India in 1H versus the guidance to reach 200 stores. So could we see any upgrades over here? And if there is any change in guidance for expansion across Toscano and international business versus what you have guided earlier?
No, so I think we'll be at around 40 outlets for this year, and our Toscano pace, I think we'll try and increase. We've only done 2 this year, and we hope to do 2 more. One is under construction, and 1 more will go under construction in next few days. So that one portion which we'll try and increase. International, like I said, we're only doing it from the profits that we're generating that business. So this year I don't see more than 1 happening, and maybe subsequent year maybe 2 more. So that's the way it will move. Will 40 change next year to 50? I think like I always mentioned, it all depends upon the kind of site that we get and whether they are doable site or not, right? So I don't think we'll take pressure of opening up more sites. But if the business makes sense, if the trade area makes sense, if it doesn't leads to significant cannibalization to our nearby store, or the market dynamics different and the rental sort of is something that can sustain our business, we'll do it.
Got it. That's all from my side. Thank you and all the best.
Thank you, Mandeep.
Thank you. We have a next question from the line of Vishal Gutka from Phillip Capital. Please go ahead.
Yeah. Hi team, congrats on a good set of numbers. I just wanted to know what % of revenue generally comes from corporate group meals, and now then IT companies insisting a lot of employees to come at least thrice or twice in a week. Do you see big revival coming through in the coming quarters as and when see that more and more people attending the office?
So this segment has increased. If I look at sequentially, last 6 quarters it has gone up definitely. Better in the month of in quarter 1 and quarter 2. Quarter 3 again, very early days. Also, a lot of festivals, people went home, so that business was slightly obviously get impacted every year around this time. But like you said, IT companies are asking people to come back. We should see good sort of movement in the subsequent part of the year.
Oh.
Look, we can't tag. Sorry, just to I know that I gave you very open. Just we can't tag the customer as IT. The way to track also is what is the group portion of the business. As in how many transactions had more than say 8 covers per transaction, and then how many transactions happened during weekdays, because these 2 are the main parameters in which IT crowd comes in, right? And both of these parameters, like I said, have been improving quarter on quarter.
Got it. Thank you. Thanks a lot. Thank you.
Thank you.
Thank you. We have our next question from the line of Vicky Punjabi from UTI Mutual Fund. Please go ahead.
Hi, Rahul. Thanks for taking my question. Just one observation which I wanted to clarify. Now, if I look at your delivery sales, it seems that the contribution from your own app has been steady or slightly improved sequentially, while your aggregator revenues have declined sharply. I mean, is it something that we are missing in the aggregator platform, or is the competition level high that we are seeing this impact? Or is this just a general change in the customer behavior? Where are we seeing the real impact of delivery coming in?
No, so Vicky, don't correlate the two numbers, because if you look at our own digital asset contribution, the large part of contribution is actually from our dine-in business, right? So our stated point is, in our dine-in business, we own our customer. Approximately 28-29% comes from our app and website. Another 25% comes from our call center, and then there are some walk-in. And our dependency on the third-party aggregator for dine-in business is actually extremely low, which is single digit. So that is on the dine-in part. On delivery part, on the other hand, large part of the business comes from these aggregators. So that mix has not changed. In delivery business coming from our app has always been based on quarters, based on COVID quarters over the period of last 2 years, in the range of 10 to 15%. And also, given that delivery is now around 30% of the business, this delivery segment doesn't move significantly the own digital asset contribution business, right? So those two are not correlated. I don't think we are missing much on these aggregator platform in terms of marketing. Like I said earlier, the focus was to stabilize this business. I believe, and there's a number that I'm seeing on a monthly basis, I believe this is stabilized. Hopefully, you guys will see it next quarter. And then we will take it up to grow it further. But long-term perspective, I think all of us are believers in delivery segment, and this is something that we will build over a period of time.
Sure. So how do I look at this aspect? The last year that we were doing that 55 crore run rate, and today we have more stores but less amount quantum of delivery. So is today the steady state, and last year possibly helped by COVID, and so dining segment closed and customer opting for barbecue through delivery, and last year base was overstated, and this is what we are seeing is a normalization of base, and from here we grow. I mean, how do I look at this business now incrementally going forward?
I think you should look at it in that manner, because both the decline in delivery has been pretty much inversely proportional to increase in our dine-in business, right? I think now is the time when we are seeing pretty much stabilization on delivery. So if you compare it against last year, obviously the decline is largely because of the impact of COVID, and obviously one of benefit that we would have received now in the previous years. Obviously, we didn't want it that way, but this is where it is right now.
Sure. And I just needed one clarification from the dine-in segment, because I didn't understand one of your previous answers completely. So now, if I look at the dine-in revenue for this quarter versus say pre-COVID levels, and we've taken price hikes out there as well. So is the dine-in revenue actually higher than pre-COVID levels, or is it similar, and the footfalls that have declined have been offset by price hikes? I mean, is that the way to look at that business?
You mean on a per outlet basis?
Per outlet basis, yes.
Yes. So if you look at pre-COVID same quarter, it is on the same mature portfolio. Just dine-in business, it is pretty much same. It's flat. Yeah.
Okay. So price hikes have actually just offset some of the lower footfalls that could have happened. Is that the way to look at it?
Yes.
Or that? Yeah. Okay. Sure. That's it from my side. Thanks a lot, Rahul.
Thank you. We have our next question from the line of Manish Poddar from Motilal Oswal AMC. Please go ahead.
Yeah. Hi, Rahul. Just a couple of questions. First one is, how much is the actual rent paid in the first half? FY23, sorry.
Actual rent paid?
Yeah. So I think you said 80 crores was the cash flow, I think post-rental. Is that the number?
Sorry, I have to
because the reported number is 135 crores cash flow. So if you and rental gets reported below.
Yeah, around 62 crores actual rental paid.
62 crores. Okay. And just one more.
So you're right. So it's around 10% of our top line. So yeah, so 620 minus into 10%. Broadly that number, yeah, 62 crores.
Okay. Just one more question. So let's say, Rahul, you'll be seeing probably more stable sales now Q3 onwards with, let's say, things opening up. Is there a possibility, or have you seen that across any of your cohort of stores where, let's say, and now incrementally RM should also stabilize. So I'm just trying to understand, is there a possibility in some micro markets where you've been able to price your product significantly higher, or let's say even because there's more demand and there is less supply, and of the couple of metrics both on RM and, let's say, footfalls favor you. I'm just trying to understand, is there any cohort in the entire 180 200 stores network where you have seen any sort of more demand and you being able to charge, let's say, 10% more and still customers coming in again and again?
So look, our like I said, our average pricing between last year and this year has gone up by around 7-8% already. And as a brand, we always want to be value driven. So overall, at a company level, this pricing will sort of not change much in H2. But in terms of few markets, our pricing has always been different. So our metro pricing in some of markets like Bombay, Delhi, Bangalore is different than what we charge in some of the other locations. So that our pricing can be different within the same city also. So our pricing strategy has always been what is relevant for that market and what is the right pricing for that market, and we follow that.
Actually, what I'm trying to get is primarily 2 points. One is, the pricing elasticity, because in some micro markets like BKC, you all are pricing north of 1,000 rupees and still customers are flowing in. What I'm actually getting a broader sense is, there'll be days where you can price your products, let's say, 5-10% more, given that the demand is more, and given COVID, a lot of this big format chains have kind of closed down. So are you witnessing any sort of trends like that, or that's not the case as such? That's what I'm saying.
Right. So our pricing is different for weekends. Our pricing is different for weekdays. Lunch, dinner also is different.
No, dynamic is fine. What I'm trying to get a sense is, let's say if you had charged 100 rupees earlier, let's say pre-COVID, now you can charge 110 on the same product because in the vicinity there are far and few restaurants of the same format, or a larger size food format. That is what I'm trying to get a sense.
So the fact is, over the period of last 3 years, be it inflation, be it annual price hike, the pricing has gone up from pre-COVID level to now. It's already pretty much 3 years gone. So our pricing would have gone up by around 20 odd percentage. So 15 odd percentage over this period of time. Some of the new ones that we launch come at a lower price point, and then over the period of say 6 months, we catch it up to the normal price of that city. So in terms of pricing engine, like I said, this is all keeping in mind the dynamics of that trade area, weekend, weekday, lunch, dinner. Sorry, Manish, I don't know. I think I'm repeating myself.
I'll take this offline. No worry. I hear you.
Yeah. Maybe I can understand your question well.
No, I'll take this offline. Thank you so much.
Sure.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have a follow-up question from the line of Percy Pantaki from IIFL. Please go ahead.
I was just looking at your same-store sales growth and calculating it on a 3-year CAGR basis. So the 3-year CAGR on same-store sales growth is somewhere around 5%. Now, if I further dissect it, so 5% CAGR is about, let's say, over a 3-year period, 15-17% kind of point-to-point growth on a same-store basis versus 3 years ago. Out of that, 12-13% or at least 10% is coming only from delivery, which was not there or very, very minuscule 3 years ago. And another 7-8% is coming from pricing. So if I remove these 2 aspects, the same-store sales growth over a 3-year period is almost zero. Is this the right way to look at it?
Yeah. So same-store sales growth of around 5 to 7% CAGR over 3 years, and with almost 2 years of COVID. Yes, that's there. Around 10% out of this came from delivery, and balance came from pricing. And like I said, there is still some cover volume with respect to pre-COVID versus now. That gap still exists. So yes, I think broadly your numbers look okay to me.
Okay. And that gap in the cover volume, now should we take that as a permanent loss, or are you hoping that it will come back?
So post-COVID, and how the corporates have moved, it's already been I think 2 years, right? My hope is that they'll come back as IT further opens up and our corporate business moves up.
Okay. Secondly, on Dumsafar, while you have launched the app, I mean, what are you doing to popularize? How will customers come to know that there is a brand or there is a place called Dumsafar from which they can order biryani?
So all the marketing spend on aggregator apps has already been happening, and if you look at month-on-month increase, there is growth in ADS from the same restaurants. In some few select markets, we're also doing offline marketing of these, and also there's digital marketing being done in these locations where we launched the Dumsafar brand. It's obviously only 2 months, 2.5 months old, so it will have to go through its journey of education in the customer's mind, and then also the product will have to speak for itself for the growth.
So you mentioned that you're expecting around 1 crore per month sales from Dumsafar. At that scale, do you think it will absorb the marketing spends? And if not, at what scale do you think this will be sort of generating sort of a decent profit for you after allowing for the marketing spends, etc.?
So, Percy, we are not guys who will go out and spend completely on building this brand on offline sort of media, right? Large part of the marketing spend happens on the same one aggregator platform, digital platform, which is largely on the data which is to the relevant customer. All the points on the performance marketing bit. So in that extent, I think even if we spend maybe 6-7% of our Dumsafar revenue and plow it back and put it back, I think slowly and steadily we'll build that business.
So at this scale,
the question is that. Sorry, go ahead.
Yeah, I was just asking, at the scale of 1 crore per month, will the brand be making similar EBITDA margins as compared to the overall company, given that there is a lot of operating leverage, you have the same infrastructure,
Yes.
Same delivery boy, etc. So at least will it
Yes.
be making that 15% kind of EBITDA margin at that 1 crore kind of scale?
Yes, that's our expectation, and that's how we have launched it. So if you look at UBQ brand, for example, when we launched it in late 2018, that business was contributing hardly 40 lakh rupees per month. And I think I'm excited about that business itself being approximately 200 crores right soon. We did that last year, and hopefully based on our quarterly run rate now we'll reach there soon. And as Dumsafar also crosses that journey of 3 to 4 year repeat business, customer engagements, that's another business that should come for us.
Okay. And lastly, on cloud kitchens, when we started this, we had a very sound logic that there are stores which are more than 5 kilometers away from the customer home, and then it becomes difficult to service that customer. And if at all it is serviced, the experience is bad because food is cold, etc., etc. Therefore, we need to open cloud kitchens. Now, what has changed in that logic for you to have paused the cloud kitchen sort of expansion?
No, so the logic remains absolutely intact. There is no change in that. But the cloud kitchen model will work at a particular ADS level, right? If the ADS comes down in a particular say sale point, be it cloud kitchen or be it the Barbeque store from we're doing, you'll start incurring losses, right? So we already have 200 distribution points from where we have to do sales, and we can strengthen our operating performance on these, and so that the sales increases and the ADS increases in these distribution points, rather than going and investing money in creating up more distribution points. So like I said earlier also, it's not that the extension kitchens are dead. First, we have to fix the ADS growth in our existing outlets, bring it to a point that it is it at least does not bleed money in extension kitchens. Once it's reached to that point, adding cloud kitchens is not a big problem for us. These are hardly 600 square feet sort of outlets. This can be done quickly, and that will do once our delivery area sort of comes back. So it is paused. That logic remains intact. It is just that today it doesn't make sense to allocate capital to a segment which potentially will lose money at lower ADS numbers.
Right. And one bookkeeping question: in a normal year, the Q3 ADS is what percentage higher compared to the Q2 ADS?
You mean at the total company level business?
Yeah.
So this would be around 12 to 15% higher between quarter 3 and quarter 2.
So sorry, this is what I meant was on a per store basis. Are you talking about the total company sales or a per store basis ADS?
So this is I was talking about more total company sale per store basis. This should be around maybe 10% higher. Yeah.
Okay. Got it. Okay. Thank you. That's all.
Okay. Thanks, Percy.
Thank you. As there are no further questions from participants, I now hand over the conference to Mr. Rahul Agrawal for closing comments. Over to you, sir.
Oh, thank you. Thanks, guys, for all the clarification participating in the call. We look forward to similar interactions going forward. Thank you.
Thank you. On behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your line.